First look at second quarter GDP, showing the economy grew at a rate of 2.8% from April to June, well above expectations. For more on the latest data and implications for the Fed's rate path, let's bring in former St. Louis Fed President Jim Bullard. He's unshackled. You can say basically, is that how, didn't you know that was coming? He's now
as
dean.
If I wasn't before.
Yeah, he's now dean. Yeah. That's true. He's now dean of Purdue University's business school, and it's good to see you, Jim.
Good to see you.
This, I mean, we're down to one, maybe. Does this throw that into question at this point? What would you do? Tell us. Finally, be honest with us. Be honest. Finally.
I think today's GDP report will take July. There was a little bit of residual talk about July. I think that'll get taken off the table here with this report. This is reassuring that the first half growth rate was probably the underlying growth rate probably between 2 and 2.5%, pretty close to the potential growth rate of the economy. Inflation news just very recently has been good, but the committee has 2 more reports before the September meeting. They'll want to see those. So I think the committee's on a pretty good track here at the July meeting to signal, but not signal too strongly, that they're probably about ready to go in September and beyond that.
In recent weeks, you can sort of feel the perception growing that the labor market might be slowing, and maybe even more than people think. And I saw someone throw in the towel on, I guess it was Dudley. You saw Dudley's comments, I guess, right?
Yeah.
He said, okay, I was wrong. We need to cut now to make sure it doesn't get worse. Oh, there it is. I can't believe that. I did not plan that. But the Fed needs to cut rates now to stem what could be something even worse in the labor market. Is that wrong? That could be wrong.
I don't think the probability of a recession is any higher right now than it is in ordinary times. Of course, we live with the probability at any time that there could be a recession, that could be a big shock. But I don't think these numbers are really pointing to recession at this point. This is more normalization in the labor market. The number of job openings per unemployed worker a couple of years ago was two job openings per unemployed worker. That came down to 1.2, which is the pre-pandemic number, but that's still very high compared to when we were talking in 2013, 2014 period where it was way below 1. So I think we've got normalization in labor market. We've got inflation just 50, 60 basis points away from target. You've got the economy growing at potential. This is a soft landing, and the last piece of the soft landing is to get the policy rate back to a more normal level and get the yield curve upward sloping, which seems to also be happening.
On almost any metric that you look at in terms of, if the first Friday of every month or the GDP numbers, it's been surprising almost for, I guess, at least a year, maybe 18 months. Is it good? Is it better productivity? Is it residual government stimulus? Is it the size of the Fed's balance sheet? I know, no, of course not, because you were part of that. But what do you attribute it to? How has it been so surprisingly resilient for so long? And is it because of good things or because of I mean, we did have inflation, and that's what happens when there's too many dollars floating around. Was that it, or is it productivity improvement?
I'm optimistic that productivity is improving. It's notoriously hard to measure. Sorry, and I, my gut instinct is that you are getting pretty good productivity. But if you look at the numbers, they're not really there yet, and so we'll have to see if that story holds. I think another thing that happened here was last year, you had this overwhelming prediction by Wall Street and global financial markets that the U.S. would go into recession in the second half of 2023 based on the problems at SVB. That turned to be epically wrong. instead of shrinking in the second half of 2023, the economy boomed. And I think that just set everybody scrambling to change their ideas. But the big picture is that the economy is slowing and has been slowing for a while, but that's because it was growing way above trend post-pandemic. It's not slowing to a recessionary situation, but just to the trend pace of growth. And that makes a lot of sense. You would grow rapidly after the big shock, and then you'd slow down to the potential growth rate. I think that's exactly what's happening. That's a soft landing.
So you think that you grow rapidly after what we went through, but it just seems like it's been of a longer duration than anyone thought. Does any of it have to do with?
I kind of agree with that. I kind of agree with that. But this was, if you look at the charts, I mean, just a gigantic shock. And you really had to dig out from that. It was pretty much a V-shaped recovery as far as macroeconomics is concerned. You probably never see anything quite as V-shaped, but still, it takes a long time to recover from such a big tsunami.
Interesting. I guess the infrastructure and the chips and IRA, none of that hurt in terms of stimulating some demand. I mean, we got a lot of that left to still spend, too. Did that have any percentage?
Yeah, I was surprised the other day. A lot of that has not been spent, and I think it tells you that that kind of expenditure is really more about the public infrastructure over the medium term and the long run, and probably doesn't affect business cycle type dynamics that financial markets worry about quite as much. So yes, there's some public projects have moved forward, but many others have not. And that's if I recall, it's a 10-year package, so it's a long fuse on that.